most important pieces of information that are released by the exchange regarding company information are company results. These are typically semi-annual and annual. In some countries there are also quarterly results. These results show the performance of the company in terms of turnover, i.e. sales, and in terms of profitability. Linked to that, of course, are any company announcements about sharing of the profits, the so-called dividend payments. Dividend payments are again usually either 6-monthly or sometimes quarterly, and are closely followed by the market in terms of showing how much profitability individual shareholders and institutions are going to get from the company's activities. In addition to dividend and results information, there is often information about company directors' dealings. All directors of companies on exchanges have to reveal any dealings they have got in their own company's shares, and many market analysts take this as a signal as to whether or not they are bullish or bearish for their own institution. All of this information is released by the exchange at the same time and is readily available to everybody who is trading in shares. In addition to individual company announcements and information, there's lots of news and information about the wider market, what's going on in other markets away from the stock exchange, indeed even global and political information. So information such as interest rate policy and monetary policy by central banks, economic data from governments. We talked earlier about GDP and unemployment data and inflation data as being important. All of this information is also cascading into the marketplace, and you have to be aware of which parts of that information are going to affect your trading strategy. Also, there are sector and industry pieces of information. Maybe an oil company has found a very large new find of oil, or perhaps there's been a new invention in the electronics sector, or a new wonder drug has been developed in the pharmaceutical sector. It may be that the individual pharma company will do very well from an announcement about a new drug, and this often lifts the shares of companies in the same sector. So there are large amounts of competing information that you've got to weigh up and be aware of if you're going to formulate a correct and successful trading strategy. What do we mean when we're talking about a share price? Well, we're looking at all the factors that come together to make that share price. The first thing to say, of course, is it's not a single figure. There is a bid and an offer, where the market is prepared to buy a share and where it's prepared to sell a share. All the information we've already talked about influences where that bid and offer may be, and indeed whether or not the price between the bid and the offer is very tight or very wide apart. That in fact is a very good way of judging how easy it is going to be to trade in that share. All of these various factors, economic data, company data, information that flows into the exchange, all come down to the price, and what ultimately determines the price is of course supply and demand. Remember, when we're looking at the share price on the exchange, there are also other factors to consider. Not just the actual price and the spread between the bid and the offer, but also the volume. Volume data gives you a good idea of whether or not it's going to be easy to trade in this share. It also tells you critically whether the market is interested in that share at a particular time. Maybe somebody's building a long-term shareholding or slowly disposing of a long-term shareholding. But one way or another, volume can be as very instructive as watching the price. Also, some companies are relatively small, so there are only small amounts of shares in issue. Clearly, a member of the FTSE 100 or the S&P 500 is a much larger stock than one of the minor stocks, maybe in the junior market. So you have to understand that it'll be very easy to trade in one of the household names, but some of the small cap stocks, for example, will be tightly held and difficult to trade in. So it's not just price, it's understanding volatility and volume as well. Some of the most dramatic and exciting price action in stock markets happens when there is merger and acquisition activity. This may be an agreed bid or a contested bid, but in either case we often see sharp and volatile price movements. This, of course, represents a trading opportunity, and as such, the marketplace always very carefully watches and analyses any ongoing M&A activity. One should remember, of course, that the outcome of a bid or a merger doesn't necessarily involve a cash settlement. It might be you don't get cash in return for the new deal, you get shares in the new company. Now, you can then sell those shares later if you wish to, or you may wish to stay on board for the ride in the new institution. Commodity markets offer traders a large number of interesting opportunities. They are typically quite volatile and very active markets. There are a number of ways that you can trade these markets. You can trade in the individual commodity, gold or oil, or maybe wheat or copper, and you can also trade in the producers of such commodities, typically the mining or exploration shares. Now, the interesting thing about commodities is that they don't move in sync with other markets. So sometimes if there's no action going on in other marketplaces, you can start trading in commodities. Some of them traditionally are also seen as a way of taking advantage of market moves in other areas. For example, if you were worried about inflation, it would be typical to buy gold. Gold is seen as a good way to protect value if cash is being eroded by inflation. If you believe the world economy is going to pick up in a big way, base metals are often a way to trade the markets. People look particularly at the copper price as a way to take benefit of any moves in the global economy. If you're uncertain about the individual commodities, or you don't feel you have enough information or ability to trade individual commodities, you may want to look at mining and producing shares, where there is probably more information available that is more easily digestible. The important thing though is whether it's the individual commodity or the mining share or producing share, is there are a large number of opportunities you can take advantage of in this sector. Volatility is a key part of commodity trading. There are a number of external factors that can cause sudden and sharp moves in the price, shocks to the system if you like, not entirely related to what is going on in fundamental economic data. One thinks of weather, it can be politics, all forms of disruption that can affect the price. At first look, this may seem bad news, but in fact from a trader's point of view can be quite good news because it allows for volatility and for new trading opportunities. It is often the case that some markets are dull and boring, but that is rarely the case in commodities. The world foreign exchange market is the largest market in the world. It trades some $2 trillion a day. This offers a large number of opportunities and trading ideas that can be employed in this marketplace. Typically there are around 10 or 12 major currency pairs, normally trading against the US dollar or against sterling, yen or the euro. The markets are 24 hours a day, though there are quiet periods within that 24 hours, but they do offer a large number of trading opportunities. Market participants range from people who trade many times an hour to people who only trade 2 or 3 times a year. Because they are large and liquid markets, it is possible to get in and out very quickly and very effectively. The foreign exchange market has a large number of different actors, be it central banks, fund managers, corporate treasurers, and of course speculators. They all have different motives and different time horizons for the way they trade. This means that the speculator or the short-term trader can gain great opportunity by trading against people who are not so profit-driven as themselves. Many large corporations in fact only trade a few times a year, and central banks are not in the business of foreign exchange to make money, but to stabilise the markets. This means that there is effectively money left on the table for the quick and nimble operator within the marketplace. To do this, of course, you need to understand which currencies are in vogue and have got depth of liquidity. Typically, foreign exchange dealing is very short term, because it is volatile with plenty of price movement and opportunity.